Hi investors, welcome to SOIC. So in today's video, we'll be talking about top 5 reasonably valued businesses that I'm studying right now. So again, before I start the video, this video is not meant for as a buy or sell recommendation. These are just those businesses which I've been studying right now, and I'll be posting detailed videos on these businesses going forward as well. So what we'll do in the video is that we'll go to different sectors and we'll try to identify companies which are reasonably valued, and these are the companies which I'm studying right now. And one common trait across all these companies will be that these companies will be probably will be doubling their net block, that is the amount of property, plant and machinery that they have, and they'll be doing a lot of capex going forward. And most of these capex will be done from internal accruals, or some of these companies will also be taking debt. And one more factor that we are trying to identify for making this video is that these companies will have competitive advantage in place. Is that majority of these companies will have return on capital employed above 15%, which ensures that their ROC is more than their cost of capital. And this is why we are studying these businesses. And also one thing that we'll try to do is that these businesses are reasonably valued. So this is why we are studying them. So coming to the first business, and this business belongs to the hospital sector. So last year as well, we made a video on top 5 reasonably valued businesses where we talked about KEI Industries, Usha Martin, HCL Technologies, Narayana Hrudayalaya, and a lot of those businesses also did well. But even at that point of time, our idea was to look at multiple sectors. So this time in the first business pick that we have is a business by the name of Narayana Hrudayalaya, which is a hospital. So why are we studying this business at the moment, and basically why are we doing a lot of homework on this business? So first simple reason is that this business is going to double its net block going forward. That is, currently the business has a net block of almost 2000 crore on its balance sheet, and the company is doing almost a 2000 crore capex in the next 2 to 3 years. So when it comes to analyzing the hospital sector, one thing that we have to remember is that there are multiple types of capexes. So one type of capex is a brownfield capex. So what is a brownfield capex? Suppose if a hospital is already present and it already has an adjacent land right next to its hospital building. So if the hospital ends up expanding in that manner, so then it will be considered a brownfield capex because it already has the land in place and it is already partly utilizing the land. Second type of capex is greenfield within a new city. Now suppose if Gangaram Hospital from Delhi goes to Mumbai and sets up a new hospital. So Gangaram is a very famous hospital in Delhi, but Gangaram is not so well known in Mumbai. So it will take Gangaram 6 to 7 years to just break even. So this is greenfield within a new city. So this is why you'll see like businesses like Kim's Hospital, where a lot of greenfield capexes have been around in new city. Then probably this is one of the reasons why the stock has been flat as well. So third type of capex is greenfield within the existing city. Now suppose if a hospital has run out of space and it wants to expand within its existing city. Now suppose if Gangaram wants to open one more hospital within Delhi. So because the brand name is already established, so it is much easier to utilize the capacities. So this is what Narayana Hrudayalaya is doing right now, is that they are doing greenfield within existing cities. That is, they have one hospital in Cayman Island and over there they are setting up oncology blocks. So cancer is a very fast spreading disease, and what has happened is that this therapy is growing at a very fast pace. So they never had an oncology block in Cayman Island. So they're setting up an oncology block in Cayman Island. Secondly, they're also doing these capexes in Bangalore as well. In Bangalore, they have a very large established hospital, and they're also looking for land for doing capex in Kolkata. So basically all the capexes which will be done going forward in next 2-3 years will be done within the existing cities. And this is why we are studying this hospital. Because if you look at the balance sheet of this company, the return on equity of this company, what is the formula for return on equity? That's net profit upon shareholders equity. The return on equity, if you just look at this quarter and analyze it, the return on equity for a hospital is more than 27 to 28%. So again, if I tell you about a business where ROE is 27 to 28% and it is doubling its net block over the next 2 to 3 years. So that is why we end up studying the businesses. If you look at this piece of note from the con call, so in the con call they are talking about is that they are spending 2000 crores to double their net block, and the type of return on capital they expect is close to 20%. So again, that gives us an idea that roughly their payback will be close to 3 to 4 years when they do capex. So this is why we are studying this hospital, because PE ratio as well isn't too elevated as of now. If you go to on a forward basis and even on a trailing basis, if you look at it, so PE ratio is 30, whereas peers are trading at a PE ratio of more than 40 times. So this is the first business that we are studying right now. Now coming to the second business. Now second business belongs to a commodity sector. And what is the commodity sector? That is iron ore production and iron pellets production. Now this is a commodity business where the debt on the balance sheet has fallen from close to 2000 crores to being net debt free. Currently the balance sheet actually has cash. So if you just look at the balance sheet right now, so company, if you subtract out all the debt of the balance sheet with the cash and investments, the company will have actually 538 crores of cash and investments on the balance sheet. So from a position of more than 2000 crores of debt to almost being net debt free is something that we definitely want to study as well. So remember, last year we studied a business by the name of Usha Martin, and over there as well a lot of deleveraging happened, and that business sold off its steel plant and it almost became net debt free. So similarly, this is a commodity business and the type of commodity business that we are studying right now. So you have to be very, very careful while you're listening to this analysis, because commodity prices fluctuate a lot. And if commodity prices fluctuate, then the stock price also automatically fluctuates. But what we have to be very understanding of is that whenever we are talking about commodity businesses, so you have to look at it from a bottom to peak cycle or from peak to peak cycle. But if you end up analyzing these businesses at a peak cycle, like this business was at a peak cycle in 21, then it becomes very risky in the near term, that is next 2 to 3 years. So the name of the business is GPIL. And why are we studying this business? Is because this business has announced massive capacity expansions. So what does the company do? Is that the company is a producer of iron ore and also a lot of products in the downstream. That is, it does iron ore mining, iron ore pellets, and also it is setting up its own steel plant at the moment, because it will be purely integrated because they already have the raw materials in place. So what is the expansion that the company is doing right now? So for iron ore mining, currently the capacity is 2.35 million tons, and they're spending almost 200 crores to expand the capacity to almost 6 million tons. Whereas for iron ore pellets, where they're exporting a lot of high grade iron ore pellets, currently their capacity is 2.7 million ton, and they're adding additional capacity of 3 million ton. That is at a cost of 800 crores. And this entire capex will take 18 months in the case of iron ore mining, and it will take 36 months in the case of pellets. If you look at the competitive advantage of the company, it is ownership of a proprietary asset, that is the mines. If you look at captive mining edge, then the market price of iron ore, if you just compare it with the captive ore landed cost, because they have their own mines, then you will see almost a 40 to 45% difference. So this is why looking at such type of companies becomes very interesting. And finally, if you look at the free cash flow generation of the business, so post FY17, the company has consistently generated free cash flow. In FY18, it generated 82.7 crores. In FY19, 221 crores. In FY20, 163 crores. In FY21, 775 crores. And in FY22, company generated nearly 704 crores of free cash flow. So that is why we are studying such type of businesses, because see, we don't know where the commodity prices go. That is for sure, right? So there is a commodity pricing call as well. But if the company is debt free, and if the company has plans of expansion in till FY25, FY26, and even till FY29, because their long-term plan is to take the iron ore capacity to almost 9 million tons per annum, which is currently close to 2.7 million tons per annum. So if those things end up happening, and if the balance sheet is debt free and the company is free cash flow generating, then over a period of time, just because of one cycle, these things become very interesting. But mind you, as a retail investor, you have to be very careful, because these are commodity businesses, and if you're studying commodity businesses, then fluctuations will happen, like what happened in Rain Industries, like what happened in HEG. So remember, these are commodity businesses. So this was the second one. This was something unique, because after a lot of time we studied a commodity business on the channel. Third business now belongs to the QSR category. So name of the business is Westlife, and Westlife is the master franchisee of McDonald's in West and South India. So you might be wondering that the PE ratio for this business is close to 100 times. Then why study this business and why even call it reasonable in the first place? So what you have to realize is that in this business, in last 10 years, they've opened a lot of new stores, because of which the depreciation spends look elevated. So in such type of a scenario, what we prefer to look at is cash PAT. That is just looking at the profit after tax and adding back the depreciation. But in this scenario as well, because of Ind AS 116, the picture of depreciation also looks a bit like elevated. So we try to subtract all the rent costs as well from depreciation. So probably by FY23 end, this business is going to do 250 to 260 crores of cash PAT, and this is already given in their investor presentation. You can check as well. For 9-month FY23, they have mentioned 250 crores of cash PAT. If you subtract all the rentals and if you just analyze it to FY23, so their cash profit after tax will be close to 250 crores. And currently the market cap is close to 10,800 crores. So basically on a cash PAT basis, this business is at a 43 to 44 times cash PAT earnings. But again, what you have to realize, even though the business might look a bit expensive, but in Indian context, when QSR companies end up growing, they definitely get a higher multiple as compared to others. So what is the rationale for studying this business at the moment, and why I'll be making a video as well? So recently I visited Bangalore, Mumbai, and I also went to Hyderabad, and in all the three places I went to McDonald's as well. So simple reason was that McDonald's, usually earlier when I used to go to McDonald's like 10 years ago, then the burgers which I used to have used to cost 30 or 40 rupees max. But these days, if you go to a McDonald's in Mumbai, or if you go to a McDonald's in Hyderabad, or if you go to a McDonald's in Bangalore, then you will realize that they have launched gourmet burgers, and also they have launched meal options. And there is also McCafe, which is present within the McDonald's store only. So what has happened is that the per bill value, like per order bill value, has gone up. So this can also be seen by this data that in 2015 to 2016, their average sales per store per annum used to be somewhere between 4.5 to 5 crores. And that has now gone almost close to 7 crores. Why has that happened? Because of these new innovation in the menu. Is that now if you go to a McDonald's, then if you even order one meal, then that meal will cost you close to 350 to 400 rupees. So just to give you some scuttlebutt feedback, that like 6 of us went to McDonald's and our final bill value was close to 2300 rupees. And just 8 or 9 years ago, I could have never imagined myself paying 2300 rupees for 6 people in a McDonald's. So what has happened is that they have given their FY27 guidance, is that in the investor day that they have planned for opening 620 stores, which are currently close to 340 to 360, anywhere between that, and they want to double their sales. So what is the guidance? Is that they want to take their sales to 4,000 to 4,500 crores. And what is the profit after tax margin guidance? It is close to 8 to 10%. So you can just simply create a bear and bull scenario. Is that in a bear scenario, you can just take 4,000 crore as sale and take 8% as PAT margin. In a bull scenario, you can take 4,500 crores as sale and 10% as profit after tax margin. And what is happening in this industry is that if you look at the entire size of opportunity, so the Indian informal eating out industry is somewhere close to 3.2 lakh crores in size. And what is McDonald's catering to? It is catering to chicken, burger and desserts, which is 66% of the market. If you also look at this South India McDonald's stores, they've also launched fried chicken, and fried chicken has already started contributing 50 lakh per annum in one store sales in South India. So that also gives you an idea, is that McDonald's isn't taking any format risk. Whereas if you look at the story of Jubilant Foodworks, they're opening Honk's Kitchen, they're going for Popeyes. So that is the idea of a format risk, that we don't know if those formats succeed or not. Whereas in the case of McDonald's, they're doing all these innovations within their existing format. So this is one of the businesses which I've been studying in the QSR space. And also in the recent quarter results, if you look at same store sales growth, and what were your sales growth from the same store? So McDonald's undoubtedly ended up outperforming Devyani, Sapphire and also Jubilant Foodworks. So this is why this is one of the businesses that we are studying within the QSR space. Now before we talk about the fourth business, the three biggest problems for a retail investor are, that is when to buy, when to pyramid up and when to sell. And these three problems are so big that retail investors end up averaging down on a losing stock. So let me tell you about a story of my uncle, that he bought one of the housing finance companies in 2018-2019 by the name of DHFL. And he started averaging down in it. And he kept on averaging down till it became almost 65 to 70% of his portfolio. And what ended up happening is that the stock kept falling and he kept averaging down. So this is why a framework in place is really important, because if you have a system and a framework in place, you will never ever blow up on a portfolio level. One or two stocks will always be in losses, but you have a framework in place of 3 W's, that is when to buy, when to pyramid and when to sell. Then at a portfolio level, it will be really difficult to make losses. So in the SOIC membership, we have a detailed course of almost 14 hours, which will help you to understand when to buy, when to sell and when to average or pyramid. And that is the mission of SOIC membership, is to create a system for you to address all these important 3 W questions. If you want to sign up for the SOIC membership, then the link is given in the description box below. Coming back to the fourth business, and fourth business that we have over here again belongs to the consumption category. And this is a business that we have already discussed in a video 5 to 6 months ago. Name of the company is CCL Products, and it is the world market leader in processed coffee. If you look at the entire coffee value chain, then you will see that there are people who are growing coffees, who own coffee plantations. Then you will see there are people or industries which are involved in coffee processing, and then there are people who are involved in trading of the coffee, and finally then there are businesses which are involved in coffee retail, and then there are businesses who also have their coffee shops. Throughout the entire value chain, the coffee processors make the maximum amount of return on capital employed, and CCL Products is the world's largest coffee processor. So what is happening in the business is that the business has more than 1000 blends of coffee, and suppose if you're a customer of CCL Products coffee, then what ends up happening is that if you buy your coffee from any supermart, and if that supermart changes its supplier from CCL to someone else, but you like that particular taste of coffee, so it becomes very difficult to change the suppliers, because if you change the taste, then the customer might stop coming back. So this is why having a customer in place or having like CCL product in place as your supplier makes it a very sticky business. So looking at this business, why study it? Because after 2011 to 2016 phase, when the stock went on to become a huge multi-bagger, the company expanded its capacity. They more than doubled the capacity. And between 2016 to 2020, the stock was stagnant because the capacities were just stagnant. They didn't increase the capacities at all. Now post 2021, they've announced that they will increase their capacities from 37,500 tons to almost 77,000 tons by the end of FY25. So this is why we are studying the business, because this business again is in that phase where the growth will be accelerated as compared to the last 4 years. And they're also trying to make a B2C brand within the Indian subcontinent. Is that they've also launched Continental Coffee within India. But majority of the revenues still come from B2B, that is by selling to other businesses and processing coffee as per their needs. So this is the fourth business that we are studying. And finally, coming to the fifth business that we are studying, is that we've studied a lot of times on this channel, is a bank by the name of Equitas Small Finance Bank. So this bank used to be 60% of unsecured loans, that is microfinance, and over a period of time, microfinance is only 18% of the product mix. So 82% of the product mix is of secured loans. And finally, after multiple quarters, the bank, after a long time, delivered a return on asset of more than 2%. I think in the recent quarter, their return on asset was close to 2.2%. And also after the reverse merger has been completed between Equitas Holdco and Equitas Small Finance Bank, what has happened is that the book value per share for Equitas Small Finance Bank has gone up to almost 45 rupees, because there was some cash lying on the balance sheet of Equitas Holdings. So when you do a reverse merger, that cash gets added to the net worth. So currently the net worth is close to 5,000 crores and the entire market cap is close to 7,200 to 7,300 crores, and the price to book value on a trailing 12-month basis is close to 1.4 times. So we have seen in the Indian context, when the return on asset crosses 2% and when the return on equity crosses 15 to 16%, financiers or banks usually in the Indian context end up getting 2 to 3 times price to book. So we have seen that with the past case study. It might not happen with this one, but we are just studying the business because of the valuation arbitrage and because of superior return metrics as compared to a lot of peers. So these are the 5 businesses that we are studying right now. So apart from this, other 2 businesses we are studying right now is that one is into chlorination chemistry again, but the market cap is less than 1,000 crores. So you can go and find the business using your screeners. And the other business is into casting. So these are the 2 more businesses that we are studying, because the PE multiples for both these businesses are less than 15 times. So these are the top 5 businesses that we are studying right now, and we'll be posting detailed analysis on some of these businesses in the coming weeks forward. And also, if you love this video, do not forget subscribing to the channel and liking this video, and also let me know in the comment section below that which business you find the most interesting and which business you are also going to study. Thank you so much for joining us. Hope to see you in the next business analysis of SOIC. Jai Hind.